Today, we're going to pull back the curtain on something called insurance solvency. It's basically the rule book that makes sure the company you pay every month can actually pay you back when you need it most. You can think of it as the ultimate financial safety net.
And this is the big question, right? It gets right to the core of why we even buy insurance. You're trusting that your money is safe and that the protection you've paid for will actually be there. So, what underpins that trust? Well, the answer lies in something called supervisory reserves.
Okay, so what are these things? Simply put, supervisory reserves are a mandatory financial cushion. Regulators force insurance companies to hold this extra pile of cash to prove, beyond a shadow of a doubt, that they can handle major financial shocks and still keep every single promise they've made to policyholders, no matter what.
And this visual makes it all super clear. On one side of the balance sheet, you've got the insurer's assets, all their cash, investments, you name it. And on the other side, you've got their liabilities, which are really the promises they've made to people like you. That little slice of capital on top, that's the safety buffer. That's the whole ballgame. It has to be big enough to soak up any unexpected hits.
So, here's our game plan for today. We're going to start with the old school rulebook, Solvency I. Then, we'll get into the massive game changer, Solvency II. We'll pop the hood and see how its engine works. Look at how it's still changing, and then wrap it all up with why this stuff is so important.
All right, let's turn back the clock and start with the first real attempt to get everyone on the same page across Europe, Solvency I.
Solvency I was pretty straightforward, maybe a little too simple. It basically told companies to be prudent, and then tacked on a capital requirement based on this rigid one-size-fits-all formula. For a life insurer, it didn't matter what your specific business looked like, the math was always the same. You had to hold 4% of your reserves plus 0.3% of the total amount you'd insured.
But you can probably see the problem here. That simplicity was its greatest weakness. The formula was blind. It treated a super conservative insurer the same as one taking on huge risks. It just had no way of knowing what dangers were actually lurking in a company's books.
So clearly that had to change. This massive flaw led to a complete rethink and the birth of a much smarter, more dynamic framework, Solvency II. And this comparison just says it all. We went from a rigid formula to a system that's actually sensitive to risk. Now, this wasn't happening in a vacuum. It was part of a huge global trend in finance, kind of like what the Basel Accords were doing for banking. The whole point was to create a system where the amount of capital you have to hold is directly tied to the specific risks you're taking on.
So how does this smarter system actually work? Well, it's all built on something called the three-pillar framework.
Think of it like a sturdy building. You've got these three powerful pillars, and they all work together to hold up the entire system of financial stability. Let's break them down one by one.
First up, Pillar 1. This is the mathematical core, the absolute heartland for the actuarial world. It sets out all the nitty-gritty rules for the calculations, how you value your assets, how you value your liabilities, and exactly how you figure out the size of that safety buffer. This is where the heavy-duty math lives.
But it's not all about the numbers. Pillar 2 is about the company's behavior. Regulators want to know, do you have good internal controls? Is your leadership team on top of things? Do you actually understand the risks you're taking? It's the qualitative human side of the equation.
And Pillar 3 is all about dragging everything out into the sunlight. It forces companies to publish incredibly detailed reports. This goes hand in glove with new accounting standards like IFRS 17, which provides a common language for how insurers report all this complex stuff to the public. The thinking is simple. Transparency keeps everyone honest.
Okay, let's dive back into Pillar 1 for a second. There's a key term here, technical provisions. It sounds complicated, but it's just the official name for the total value of an insurer's promises to its customers. And it's made of two parts, the best estimate liability, or BEL, and a risk margin. So the BEL is exactly what it sounds like, the company's best, most realistic guess of what it will need to pay out in the future. There's no extra padding, no artificial prudence like in the old days. The safety buffer comes from the second piece, the risk margin. A good way to think about the risk margin is to ask, what would another insurance company charge to take over all these promises and their associated risks? That's the extra layer of protection.
Now, on top of all that, we have the main event, the main capital buffer. It's called the Solvency Capital Requirement, or SCR. This is the big one. This is the extra capital an insurer needs to hold to be 99.5% sure it can survive even a really bad year.
So what does 99.5% confidence really mean in practice?
It means holding enough capital to survive a catastrophic event that's so bad you'd only expect to see it happen once every 200 years. We're talking about a shock on the scale of a major financial crisis. This is what's designed to keep the lights on and the claims paid, even when the world gets chaotic.
But there is one final line in the sand. It's a hard floor below the SCR called the Minimum Capital Requirement, or MCR. If an insurer's capital ever drops below this level, well, the alarm bells are ringing and the red lights are flashing. That's when regulators step in and the company is in real danger of losing its license to operate.
Now, of course, these rules aren't just carved in granite. The financial world changes, and so the regulations have to change right along with it.
A perfect real-world example of this is what's happening with Solvency UK. Now that the UK is out of the EU, it's tweaking the rules to better fit its own market. It just goes to show you that these are living, breathing frameworks. And it's not just about politics. The rules are also constantly being updated to tackle new threats, like the financial risks from climate change or massive cyber attacks.
So, after all of that complexity, the pillars, the acronyms, the calculations, let's zoom back out. Let's get back to the fundamental reason any of this even exists.
And really, this quote from our source material just nails it. At the end of the day, the principle is simple. For every single risk an insurer takes, there has to be a real, tangible pile of money set aside to cover it. It's the mechanism that turns an insurance company's promise into a rock-solid guarantee.
And that brings us to our final thought. The world isn't standing still. As financial markets and global risks keep changing, the billion-dollar question for regulators will always be, how do we make sure these rules adapt fast enough to keep our financial systems and our promises safe?